Well, Sasfin reported a 22% growth in first half-year headline earnings per share to 198 cents. The banking group saw an 11% increase in deposits, while total gross loans climbed 16% to 3.2 billion rand. And joining us to unpack the numbers and more right now is Sasfin CEO Roland Sassoon. Thanks so much, Roland, for joining us this afternoon.
Thank you.
Well, as I mentioned, HEPS up 22% in the first 6 months through to December. Take us through the half-year period that was for Sasfin.
Well, it was a good period really all round. The business banking division did well, as you say, with 16% increase in loans and a reduction in cost to or credit losses. And the other divisions also did well. The wealth division did very well, the commercial solutions division did well, the treasury did well. So it was an all-round performance.
So an all-round performance, a commendable performance. Is it sustainable? That's the question, because we're operating now within a very challenging environment, and the banking sector landscape has changed significantly. We're seeing increased regulation coming to the fore and increases in the cost of compliance as well.
Yes, so we have commented that we believe it is very much sustainable. In fact, we are seeing in the second 6 months a continuation of that performance. And looking forward, we see it getting better. Our management is very strong all round. Each of the divisions is well placed. We've got all the infrastructure in place for a bank. It hasn't been easy to get all our compliance, and of course that is impacting on our cost to revenue ratios. But as we get scale, and that's our whole objective, is to scale up all round, that cost to revenue ratio will come down and our ROE will go up.
Yeah, so let's take a closer look then at some of the detail as to how exactly you're looking to scale up here, because a specific mention in your results being made of an expansion of the non-interest revenue base.
Yes, well, that's our wealth division, our commercial solutions division, and they're doing very, very well. You might have noticed that we got 2 Raging Bull Awards in our wealth division. Our asset management unit is growing strongly. Our stockbroking is growing strongly. With the acquisition of iQuad, our commercial solutions division is growing very well, including freight and insurance. So all round, we're very excited. We're feeling very buoyant. And we see a good future.
Certainly, we've got iQuad having been now fully integrated into the Sasfin stable. When it comes to this growth strategy moving forward, are you looking to be a little bit more acquisitive moving forward?
Well, we're always looking to be acquisitive, but we're very careful in what we acquire. So we're constantly looking at things, but it has to fit into our model. We have to be satisfied that we're not going to make a mistake. So far, we haven't made any mistakes with our acquisitions, and we want to keep that record intact.
Let's take a look at your cost structures right now, because you've got to have your eye on the ball on that front, because it's going to take more spending in order to get these growth initiatives off the ground.
Well, we think we've done most of the spending now. Our infrastructure is in place, so we've got a huge fixed cost element. Compliance has become huge, as you know, in the banking industry. We've got all that in place, so now the trick is to scale up, because those fixed costs, well, they're not going to grow much. And of course, as the revenue grows, it'll go straight to the bottom line.
Yeah.
So we see our cost to revenue ratio is far too high at 73%. That is really a function of, first of all, the fact that our banking business is relatively small compared to other banks in relation to our other businesses, which have a much higher cost to revenue ratio. And of course, we're a very high touch company. We provide a great service to our clients, and that costs money. But the fact is that we're too small to really get the benefits of all the regulatory requirements. But now that is all in place, as we scale up, that cost to revenue ratio has to come down.
Having said that, I mean, if you're looking at the net interest income side of things, that was up 18% as well. So certainly no slowing down that we're seeing on that front, despite the fact that you've had a negative carry incurred on the group's long-term funding base. Run us through the kind of risk you're taking on going down that route and seeing more loans being advanced.
Well, you will have noticed that our credit loss ratio is quite healthy at 0.45%, which I think compares well with any other bank in South Africa. And we hope that we'll be able to retain that credit loss ratio.
How exactly are you mitigating against the risk?
Well, first of all, we're not in micro-lending. So I think that's a big factor. That isn't a business that we're in. We're very cautious in our loans, and we take good security. So, and we watch our clients very close. We live very closely with our clients. We keep our finger on the pulse, and that's the trick.
If we take a closer look at your client base right now, I mean, your focus is on a target market comprising the entrepreneurial, corporate, yes, commercial and private client base as well. Do you see a change in that regard happening anytime soon?
Well, look, the overall economy, as we know in South Africa, is not doing particularly well. But our lending is so tiny in relation to that big pool that another drop in the ocean is not going to make a difference to anybody. As it is, the big banks control over 90% of loans and advances, and the small banks only about 10%. And we see more granularity coming into the banking world. The regulators all over the world want less concentration, and a 1% drop in market share by the big banks represents a 10% increase in market share by the small banks. So we think that this thing is moving in our favour.
So scope for growth in that regard. What about scope for growth in Africa, scope for you in Africa?
Well, we very small in Africa at the moment, but I can tell you that we are looking at an acquisition at the moment that could give us some exposure to Africa. But I can't really say more about that now.
You can't even give us a clue as to the kind of territory you're looking at?
Well, it's mainly in East Africa.
Okay, so yes, incentive coming through from East Africa, why? What kind of incentive are they putting on the table right now? Why the East African territories?
Well, as I say, there's an acquisition that we're looking at, which could be interesting, which could give us exposure to that area, you know, Kenya, Uganda, Tanzania, where we would provide trade finance. You know, we have a whole infrastructure in Hong Kong for trade finance. And there's no reason why we shouldn't be doing it in Africa, but we need to have our own people on the ground. It's no good doing it by long distance. You know, suitcase banking isn't going to work for us. So the trick is to have an establishment in these markets, and then to use that to spin out these facilities.